Here's what's coming up on Retiring Well with Michael Reese.
What Internal Revenue Code 72T does is it gives you your get out of jail free card. It says, okay, here is how you pull money out of an IRA for any reason whatsoever prior to age 59 and a half and avoid the 10% penalty. What I'm going to do is I'm going to share with you how everybody screws this up and how the financial industry as a whole is set up a bit backwards. You don't ever want to retire and you're doing a great job. Here's the problem. The economy, suddenly you have a market crash and the economy shrinks. You don't want to retire. Too bad the company says you're retiring anyway and they let you go.
And now the host of Retiring Well, Michael Reese.
Welcome to the show this week. We have 30 minutes of action-packed information designed specifically for you. So grab your coffee, grab a pad of paper and a pen because Retiring Well starts right here, right now.
Hi, and welcome to this week's AskMikeCFP.com, where you email in your questions to us. We answer them here on the show. Mike, my first question is for you, and it's from Jim, and he writes, Mike, can you explain the term rebalancing to me? I keep seeing it in retirement planning articles, and I don't think I really understand what that means.
Well, Jim, that's a great question because here's the thing. In our world, there are so many words and phrases that we've all heard of, but that doesn't mean we really understand them. And rebalancing is one of those words. And all it really means is this. You start out the year on January 1st and you have a certain asset allocation. You might, as an example, you might say, let's do it simply, 50% stocks, 50% bonds. Let's pretend that's your allocation. And what happens over the course of the year is those accounts might grow or shrink in different ways. Maybe one half of it goes up 20% for the year because it's a great year, but that same year the other half goes down 10%. Overall you're up, but by the end of the year your portfolio doesn't look like it did at the beginning of the year. Maybe you started 50-50 and at the end of the year it's 60-40 in one direction or the other. What rebalancing does, so Jim, here's the answer to the question. What rebalancing does is it simply is nothing more than saying, we started the year at 50-50, we ended the year at something different than that, so let's go and get the portfolio back to where it should be, back to that 50-50 ratio that we're targeting.
I like it. Art, my next question is for you, and it's from Alan, and he writes, I'm 66 and have no desire to retire anytime soon. We're in good shape financially. I just think I would be bored if I retired. My wife thinks we need to be planning for a situation where I can't work, so I don't know how to approach my investments. Help.
Alan, that's a really interesting question because retirement is a fundamental change, not both for your finances, but also your lifestyle. A lot of people get concerned that I'm going to be bored or I'm going to grow old in retirement. And it's true. You got to have something you really want to do. Our clients, we love hearing stories about, spending extra time with the grandkids. They're kind of giving up that job that they have for the job they've always wanted, doing that fun stuff, traveling. But, onto the question, how do you plan for that? That's a really great question. I think you still need to plan that you're going to retire at some point. Your body probably ain't going to let you work forever. Let's face it, we all want to be Superman, but it ain't going to happen. Still plan, get that nest egg growing because, long-term healthcare expenses, that could pop up. All those other, unknowns in the world that go out there are going to pop up and you're still going to need that nest egg to potentially live off of.
It's funny because we rarely talk about this. We talk about planning for retirement with the tax piece and the portfolio and all of the dollar pieces, but do you talk about what are you going to do with yourself? What are you going to do with your extra time to keep yourself occupied?
It's a big deal, especially for A-type personalities who are executives. They've got to be focusing on something. And for a lot of our clients, you brought up grandchildren, a lot of clients are doing volunteer work or they starting a consulting firm of their own. But here's something Alan, I think the name was Alan, this is a great question. Here's something you got to think about. We saw this happening in 2000, 2001, 2002. We also saw it happen again in 2008. Here's what happens. You're the kind of guy you don't ever want to retire. You don't ever want to retire, and you're doing a great job. Here's the problem. The economy, suddenly you have a market crash and the economy shrinks. You don't want to retire. Too bad the company says you're retiring anyway and they let you go. At the same time, markets have tanked. So what's happened to your portfolio if you haven't planned ahead? We saw all these people, they were forced to retire. At the worst time possible, their portfolios were cut in half, and suddenly their very comfortable lifestyle went down the tank. So what you need to be doing, you need to be looking at that portfolio and saying, all right, let's structure this portfolio in such a way that we're protecting it from market loss exposure. We don't want to expose it to all those market losses. You still want to get a decent return, but be very, very careful about the risk you're taking, because you never know when you aren't working anymore because either A, the economy shrank and you were forced out of work, or B, like what Art said, your health took a turn in the wrong direction and you can't work. You want to be financially prepared just in case.
Great advice. Mike, Art, thanks so much. Hey, we'd love to answer your question here on the show. To send it in, go to askmikecfp.com. Don't go anywhere. We'll be right back. You're watching Retiring Well with Michael Reese, because your best is yet to come.
It's your retirement. How will you live it? How will you be remembered?
Will you be able to take me on vacation?
Will you be there for my ball games?
Will you teach me your values? You'll be able to play with me.
Oh, help me go to college.
How will I remember you?
Centennial Wealth Advisory, retiringwell.com.
Hi, I'm Larry Flynn from Centennial Wealth Advisory, and I would like to invite you and a guest to enjoy a complimentary evening of food, fun, and information with me at our next financial education dinner event. We're going to discuss the important issues that could impact your portfolio and retirement. These topics include, can you protect and preserve your assets against market volatility? Can you prevent outliving your money? How do decisions in Washington, D.C. affect your retirement? How to make sure your current advisor is giving you the right advice? Can you find growth and security without risk in today's volatile market? Why getting a second opinion may be the most important financial decision of your life, and so much more. If you are a retiree or pre-retiree in Northern Michigan, then now is the time to take control of your retirement. Call us now. Seats are limited. I look forward to seeing you soon at our next dinner event.
You're watching Retiring Well with Michael Reese, because your best is yet to come. Hi, and welcome to this week's Retirement Roundtable, where I am accompanied by Mike Reese, the founder of Centennial Wealth Advisory, and we have special guest advisor with us today, Larry Flynn. Good to see you guys. Hey, listen, we're going to get right into IRS code today. Don't be scared out there. Don't be scared. We're going to talk about, guys, avoiding 72T mistakes.
Yes, 72T.
What's that?
What, you don't like 72T?
What is it?
I know anytime you get some goofy combination of numbers and letters, you know it's IRS speak, right? I mean, what is 401k or 403b? It's Internal Revenue Code. That's all it's referencing. But 72T is a code that basically what it does is it says, hey, you are younger than 59 and a half, but for whatever reason, you feel the need to take money out of your IRA. But as we know, what happens when you pull money out of an IRA before you're 59 and a half? Well, you owe tax, a 10% penalty. what Internal Revenue Code 72T does is it gives you your get out of jail free card. It says, okay, here is how you pull money out of an IRA for any reason whatsoever prior to age 59 and a half and avoid the 10% penalty.
Are there exceptions where they're not going to pay that 10% penalty if you take it out ahead of time?
Oh, yeah, there are. And Larry, can you go ahead and tell us about how that works? Why don't you?
Well, that's what 72T is all about. It's the code section that says, here's how you can take this out without and avoid this penalty. Basically, it says this. They're going to say you got your IRA. If you take that out over your lifetime, very similar to what they do when you have to take an RMD, when you have to take it out over your lifetime. And if you take it out over your lifetime, you don't have to pay the penalty. Now, you have to pay the income tax on it, but you don't have to pay the penalty.
Yeah, it's this phrase called like systematic, what is it again? Systematic and equal periodic payments, right?
Yeah.
Where it's like the way it works, Mark, is you have to go from, it's the craziest thing. You know, let's say you're 52 years old. They say, all right, here are these different formulas. What are there, like 3 of them, Larry, or something?
Yes, single life, joint life.
Yeah, there's these 3 crazy formulas. They pick one, and then here's an amount of money, and you have to take, it's not a one-time pull money out, it's an income. So you have to take it out from 52 to age 59 and a half, and then you can change and do whatever you want. But during that period of time, you've got to pull the same amount of money out every single month, every single quarter, whatever the period is that you use. And if you don't, you know, what if you screw it up? What if you don't take it all out? You don't like, oh, it's supposed to be $1,000 a month, and like you've been doing this from 52 to 57, and then 1 month you miss. You just miss because maybe you moved your IRA somewhere else. You missed a month. The IRS goes back. They say, all right, we're going to go back to when you started. We're going to apply penalties on this, that 10% penalty, all the way back to when you started. You're going to pay penalties on all that money that you've taken out along the way. It's very stringent how they do it. And it's age 59 and a half. You got to do it till you're 59 and a half or 5 years, whatever's longer. So that means if you start at 57, right, you got to go to 62. And then once you get to that ending point, you can make changes and do different things.
I got to tell you, one of the things I love about your firm is that you know these things, these important little nuances, as I like to say, that pre-retirees and retirees should know. Not all firms are built that way. Right, Mike?
Oh, yeah. And, you know, Larry, we're very fortunate with Larry because he used to do taxes for a living before he came to join us. And, I mean, you've seen this all over the place, haven't you?
Oh, yeah. Here's another case where 72T comes in, and very important for people to understand. If I'm in a 401k, there is a little known rule that says if I'm separated from service, they've let me go. If I'm age 55 or greater, I can use 72T and start taking it out over my lifetime and avoid that 10% penalty that comes when you take it before 59 and a half. So what people don't recognize is they leave their employment, they take their 401k, they throw it into an IRA, but now I don't get that exception. So it might behoove somebody to leave a little bit back in the 401k that maybe they can use 72T with, and then maybe the rest in an IRA.
Yeah.
See, that's a big deal. That's a really big deal for some people, I'm sure. Is there a maximum percentage that you can take out per year? Does it cap out at like 10% per year or 7%, or is it different depending on some scenarios?
Yeah, it really depends on you've got to run the numbers. Usually the percentage isn't huge, but it does provide quite a bit of flexibility. And you know, Larry, all I could think of, I have to say, when you talked about the little known rules, I mean, the IRS is absolutely riddled with little known rules. It's like my mother when she would play solitaire. You have 7 columns of cards, and if she got stuck, she would employ her little known rule that you can have an 8th column just in case. That's the IRS code. There's all these little get out of free jail cards. You just need to know where to look for them.
Hey, Mike, how can someone get this book?
You get the book. I'll tell you what, when they come into the office and visit with us, we give them a free copy of the book. And, you know, I want to get it out there. I want folks to come to visit with us. I want to make sure they're getting good information about their retirement planning, not just on the investments, but on all the other areas that affect their planning.
Mike, Larry, thanks so much. Don't go anywhere. A lot of great stuff to come. You're watching Retiring Well with Michael Reese. because your best is yet to come.
Life, a series of moments. A touch, a look, a laugh. Successful people. It might not be superior imagination. It just might be superior retirement planning. Imagine what's next. Plan today, own tomorrow.
NMC Extended Education is introducing an educational class titled Retirement Secrets, Your Best Is Yet to Come. Our very own Larry Flint will be the presenter. If you are nearing retirement or already retired, then this class is for you. Many things can threaten your ability to outlive your assets and retire well. The big three being healthcare, inflation, and taxes. Learn to navigate the critical issues that a retiree must deal with. Learn how to plan for a predictable and sustainable income, minimize taxes on your IRAs, maximize your Social Security benefits, and avoid estate planning mistakes. We'll also discuss long-term care concerns and what investments are appropriate in different situations. The cost is only $69. Materials will be provided and a spouse or guest may attend for free. The class will be held on 2 evenings for 3 hours each. Reserve your seats today by calling 231-995-1700. Again, that number is 231-995-1700. The class is called Retirement Secrets. We look forward to seeing you at our next event.
You're watching Retiring Well with Michael Reese, because your best is yet to come.
Hi, my tip of the week is creating a plan for long-term care. There's 3 primary approaches that you can take to long-term care. One is self-insuring, ultimately saving enough money in your retirement portfolio to help provide for those needs when it comes down to long-term care. The second approach is the traditional type of long-term care where you pay in a premium each year to ultimately have that protection to pay for those expenses. Our concern with that is we're seeing premiums increase on a regular basis. A third approach that you may not be aware of is utilizing life insurance that actually helps pay the long-term care expenses based on that death benefit amount. So there's a way where you can ultimately pay into this life insurance policy that if it's not needed for long-term care, you get to leave that money behind to your loved ones. That's my tip of the week, and if you have additional questions on this, please feel free to give our office a call or check out our website.
You're watching Retiring Well with Michael Reese, because your best is yet to come.
You made it. Years of hard work, investing, planning, and now you're here. The long-awaited reward you spent a lifetime looking forward to. But what now? After years of growing a nest egg, now you may want to manage it. Use it to fund your dreams. Make it last as long as you need it. And leave some for those you love. So what do? Wall Street continues to be uncertain, and some conservative options have dropped through the floor. How do you maintain opportunities for growth and reduce risk of loss from market changes? That's where we come in. We are financial professionals. From investments and insurance products to tax reduction strategies and guaranteed retirement income you cannot outlive, provided by the claims-paying ability of insurance companies. You've worked a lifetime to get here. Let us help you enjoy it to the fullest. For a complimentary consultation, simply contact us today.
Having no clear retirement plan is a mistake we see a lot in our financial planning office when we meet with someone new. It is extremely rare that someone comes in and has a clearly defined income plan for his or her retirement. If you don't have a clear retirement plan, call now and you will receive a free complete retirement review. There's no obligations and no cost if you have at least $250,000 saved for retirement. Here's what you'll receive: a free report that tells you exactly what you are paying your money managers, both what you see and what you don't. A tailored plan to safeguard your investments from market volatility. A tax analysis to reduce liability and increase cash flow. And a custom income plan to boost your retirement. So call now for a free, no obligations, complete retirement review. And remember, you only retire once, So let's make sure you do it right the first time.
You're watching Retiring Well with Michael Reese, because your best is yet to come.
This week in CFP Talk, we are going to talk about a very simple word. The word is planning, as in retirement planning. And what I'm going to do is I'm going to share with you how everybody screws this up and how the financial industry as a whole is set up a bit backwards. Now, here's what you need to understand about the financial industry. It starts out with all these big brokerage firms, you know, the Merrill Lynch's and UBS's of the world, or the Vanguards and the Schwabs. At the end of the day, they're trying to sell you a tool. That's what they're trying to do. And what we have here on the board, I need to explain this so you know what we have. We have goals, we have strategies, and we have tools. These are 3 levels of planning when it comes to your retirement. So here's how the financial industry works. They start with a tool that they want to sell you. Let's imagine that it's some mutual fund portfolio. That's where they start. They start there and say, you know, we want to sell these mutual funds. Vanguard wants to sell mutual funds. American funds want to sell mutual funds. Smith Barney, well, I guess not Smith Barney anymore, but UBS, they want to sell funds or stocks or whatever. And so what do? They say, we are going to start over here, and here's what we're going to do. We have to figure out some strategy that we can use to sell that mutual fund. So think about it this way. This is the area that I'm certain you'll know exactly what I'm talking about. You know, when you go to see a financial advisor for the first time, you know, what do? They ask you a series of questions about risk. They call them a risk profile questionnaire. Now, if you've seen a financial advisor, you've taken one of these. If you go on Vanguard's website or Schwab's website, you open up an account, guess what? They're going to give you a risk profile questionnaire. And at the end of that questionnaire, they spit out this beautiful pie chart. It's awesome. It's got different colors, it's beautiful, and it's this asset allocation. They give you right here an asset allocation strategy. And the purpose is to sell you into some, say, mutual fund portfolio or stock portfolio, etc. But then they think, oh, we can't stop there. We got to go a little further. We've got to figure out how are we going to make that strategy fit some of your retirement goals. Now, think about retirement goals for a minute. What are your goals in retirement? Maybe you want to travel. Maybe you want to spend time with your family. Maybe you want security, freedom, peace of mind. These are all goals in retirement. Now, there's a number of strategies that you can use to achieve those goals, but what they're doing is they're saying, here's something we want to sell, a tool. It might be a stock, bond, mutual fund, exchange traded fund, options, commodities, real estate, annuities, IRAs, 401s. These are all the tools you can put money, all the places you can put money. And what they do is they start there and say, let's figure out a strategy to sell the tool. It might be an asset allocation strategy or a growth or income inflation tax strategy. They're all strategies. They say, let's figure out what strategy can we use to sell the tool. In this case, the mutual funds and asset allocation. From there, they say, now how does asset allocation fit one of these goals over here? Maybe they say, well, you know, maybe that would fit security. You build a secure portfolio, whatever the case might be. I would set forth the argument to you that this is why people get into trouble when it comes to their retirement planning. Because here's the problem. The whole system is set up to start you over here with the tool that they want to sell you. And then they kind of work their way backwards. But is that how you really do planning? Do you do planning by starting out here and working this way? Or when it comes to your planning, shouldn't you start over here with your goals? What are your goals in retirement? What do you want your retirement to look like? What is your retirement dream? What's your retirement vision? Shouldn't you start there? And once you know what this vision looks like, what do? You identify what types of strategies do you need to support what you're trying to accomplish. And then, from there, the last thing, not the first thing, but the last thing you should be thinking about is what types of tools should you use to support those strategies. Now, here's why you get into trouble. Think about it this way. Before you retire, it's all about growth. You're trying to grow a portfolio. You're trying to grow. Your goal is growth. Your strategy is growth. The tools you use are probably stocks, mutual funds, etc. You want to grow. But what happens when you retire? When you retire, you say, wait, I'm not adding to the pile anymore. I want freedom, peace of mind. I want to be financially independent. Suddenly, the strategies you need are what? Well, you still need some growth, but you need income. You need to protect yourself against inflation. You might need some tax strategies or preservation strategies. So the tools, a lot of different strategies, which means the tools you need in retirement, very different. Retirement is a fundamental shift in life. You've got to make sure your goals are fundamentally shifting, which means your strategies need to fundamentally shift, which means your tools need to fundamentally shift. And the problem people make, they don't make that shift because they're focused on starting here versus there. All right, if you have questions about this or anything else we talk about on the show, hey, give the office a call or visit our website.
You're watching Retiring Well with Michael Reese, because your best is yet to come.
Hi, I'm Larry Flynn from Centennial Wealth Advisory, and I would like to invite you and a guest to enjoy a complimentary evening of food, fun, and information with me at our next financial education dinner event. We're going to discuss the important issues that could impact your portfolio and retirement. These topics include, can you protect and preserve your assets against market volatility? Can you prevent outliving your money? How do decisions in Washington, D.C. affect your retirement? How to make sure your current advisor is giving you the right advice? Can you find growth and security without risk in today's volatile market? Why getting a second opinion may be the most important financial decision of your life, and so much more. If you are a retiree or pre-retiree in Northern Michigan, then now is the time to take control of your retirement. Call us now. Seats are limited. I look forward to seeing you soon at our next dinner event.
You're watching Retiring Well with Michael Reese, because your best is yet to come.
Thanks for watching this week. Now remember, if you have any questions about anything we talked about or anything about your retirement planning at all, please feel free to call us, come visit with us, or visit the website. Remember, you only retire once. Let's make sure you do it right the first time. We'll see you next week.